This tutorial is going to show how to trade using perpetual futures. So briefly, we talked about the spot markets in the previous lesson. So the two ways you can get exposure to crypto are through buying spot or trading on perpetual futures or trading on futures contracts. Buying spot is preferable and is what we recommend for anybody who wants to invest and who wants to trade with no leverage. The purpose of perpetual futures are to allow you to trade assets if you want to add leverage. That's the only reason to use a perpetual future market over a spot market. And you shouldn't be using leverage on a trade unless you're using it for capital efficiency purposes and to reduce your counterparty risk. So I need to make this note right now. I'm going to show you how to go long, and in future videos show you how to go short and some more information around both of those. But you need to understand that leverage is not a tool for you to make more money. If you watch the videos on these websites, so I'm on Bybit here at the moment, which is a popular derivatives exchange, and I'm going to show tutorials on it. I need to show you the sneaky things that they do so you can avoid getting wrecked. So on the beginner's guide, there's a tutorial video which I'm going to play.
What is derivatives trading?
So in the Bybit video,
In the crypto world, derivatives trading is the buying and selling of a contract between you.
I'll just mute it and I'll skip to the part where they get particularly dishonest, in my opinion. So let's just listen to this part where they talk about leverage.
But what if you have very little capital? How can you trade derivatives to earn higher returns? That's the magic of leverage. Using leverage for derivatives allows investors with less capital margin to increase the earning potential of their trades. In this scenario, with no trading fees, if trader A has 100 USDT and wants to buy a contract for BTC at the current market price of 20K USDT, they can only open a position of 0.005 BTC. With no leverage, if the price of BTC rises to 30K, their profits remain at 50 USDT.
So note what he said there, with no leverage. If price rose from 20 to 30, he would only make 50 USDT. So they're framing that without leverage, you don't make much money, which isn't true. And then listen.
If the trader uses 10 times leverage, then their position of 100 USDT will be increased by 10 times to 1000 USDT, and their returns will be increased to 500 USDT.
And he said, by using 10x leverage, your returns will be increased to 500 USDT. So that's the part that traders, or I wouldn't say traders, that's the part that new people coming in will read and listen to. And they will think, oh, $50 is the most I could make by buying spot. But if I use 10x leverage, I could make $500. And in both scenarios, there was only ever $100 in my account. So it's like free money. And it's honestly a very seedy and dishonest way to present yourself, and all exchanges do this. There is no good exchange. There is no exchange that doesn't try to prey on the losses of their customers, okay? So if you're going to be using perpetual futures and you're going to be trading with leverage, you need to understand the correct way of doing it. So the purpose of using the perpetual futures is not to trade with money that you don't have. It's so you can trade with less money on the exchange to reduce your risk. In a future lesson, there will be a deeper breakdown on leverage and how leverage works. But for now, let's just say you use it so that you don't have to expose yourself to so much risk on the exchange. As simple as that. All right. So, an overview of this platform. If you look here, I'll take you quickly through a step. First, in the corner, select the trading pair. So, Bitcoin. At the moment, we're on the BTC USDT perpetual contract. Here you can see your assets, your available balance, and your equity. So your equity is the amount of money that you have in the account. So at the moment in this test account, I have 1,000 USDT. The available balance is the amount that is actually free to trade with or to withdraw at any one time. So at the moment, they are the same thing. But if I put a position on, the equity and the available balance will be different. Because if there's a position on, depending on whether it's in profit or in loss, my equity will change. And the available balance will change because, like I said before, if you're using some leverage, you have to secure that with margin. You cannot just trade with money you don't have. You have to secure a certain amount as margin. Place your order. So here is a simple form for placing your order. You can buy, you can sell. You can go long, you can go short. Okay, so for the purposes of this, we will say long and short when it comes to perpetuals and to futures trading. And you would say buying and selling when it comes to the spot markets. You can place limit orders, market orders, conditional orders, and you can open or close a position. You have the mark price. This is the price that triggers your liquidation. The mark price will track the index price, and it may differ from the last traded price. The mark price is the important price. It's the one that you should always keep in mind. And down the bottom, you'll see your positions and your order history. You can see current open positions, profit and loss, previous orders that are filled, and orders that are waiting to fill. So that's an overview of the derivatives trading platform. So like I said, if you're just trying to buy and sell tokens, even if you're wanting to buy and sell them with stop losses and with take profits, you don't need to be using perpetual futures. You can still use the spot market. So you should use the spot market as much as possible. But if you're interested in trading and want to be active in your trading, and you want to use some leverage so that you can avoid putting so much money on the exchange, then continue with the lessons on how to long, how to short, and a deeper dive into leverage, which is coming next.